Hello and welcome to today's video brought to you by Enigma Traders. Today we're discussing the four important stock market indices: S&P 500, NASDAQ, Dow Jones Industrial Average, and the Russell 2000. These indices are widely followed by traders, investors, and financial media. Understanding these indices can help you make informed decisions about your trading and investment strategies. Let's define what an index is, why it's important, and the pros and cons of each index. An index is a collection of stocks that represent a portion of the stock market and are used as a benchmark for the performance of the market as a whole. Indices are important because they provide a snapshot of the economy's health. They reflect the overall performance of the stock market and how well stocks in certain industries or sectors are performing. By tracking the performance of an index, investors and traders can get a better understanding of how the market is performing and make informed decisions about their investments. Indices provide a simple and efficient way for investors to invest in a diverse portfolio of stocks without having to purchase individual stocks. This helps reduce risk and provide a more stable investment. To start off, we'll look at the S&P 500. The S&P 500 is an index that tracks the performance of 500 large publicly traded companies in the United States. It is considered to be a broad representation of the US stock market and is one of the most widely followed indices in the world. Let's go to the pros and cons of trading this. The S&P 500 tracks 500 large publicly traded companies, offering a broad representation of the US stock market, and this can provide for diversification and reduce risk. Because it is one of the most widely followed indices, it provides ample liquidity for traders and investors. It is followed by traders, investors, and financial media, making it easier to access information and analysis. Now, some of the cons would be S&P 500 is influenced by the performance of a few large technology companies, which can lead to increased volatility and decreased diversity in the index. And it also only tracks US companies and does not provide exposure to international markets. Next up, we have the NASDAQ, or National Association of Securities Dealers Automated Quotations. It's a stock market index that tracks the performance of more than 3,000 technology and growth oriented companies. This index is considered to be a good indicator of the performance of technology and innovation driven companies. Some of the pros would be NASDAQ is heavily focused on technology and growth oriented companies, providing traders with exposure to some of the world's most innovative and dynamic companies. NASDAQ is highly transparent, making it easy for traders to find information about the companies it tracks. NASDAQ is one of the largest and most active stock market indices, providing traders with high levels of liquidity. Some of the cons of this would be it is riskier because NASDAQ companies listed on the NASDAQ are generally more speculative and carry higher risk, as they're often in earlier stages of the life cycle and may not yet be profitable. NASDAQ is known for its volatility and prices can fluctuate rapidly due to changes in market sentiment or company news. NASDAQ is heavily focused on technology and growth oriented companies, so it may not reflect the performance of other sectors or the overall market. The next up, we have the Dow Jones Industrial Average, also known as the DJIA or the Dow, is a stock market index that measures the performance of 30 blue chip stocks listed on the New York Stock Exchange and the NASDAQ. The DJIA was first introduced in 1896 and is one of the oldest and most widely followed stock market indices in the world. The DJIA is designed to reflect the performance of the US stock market and is seen as a barometer of the health of the American economy. The 30 stocks in the DJIA are selected based on the market capitalization, liquidity, and industry representation. Some of the pros of this would be the Dow Jones is one of the oldest and most widely followed stock markets. It is a good representation of the US stock market. It includes some of the largest and most well-known companies in the world, such as Apple, Coca-Cola, and Johnson & Johnson. However, the cons of Dow would be limited diversification. It is heavily influenced by the performance of a few large companies, which can lead to increased volatility and decreased diversity in the index. It also has limited exposure because it only tracks 30 companies and does not provide exposure to a full range of companies in the US stock market. Next up, we have the Russell 2000. It is an index that tracks the performance of 2,000 small cap companies in the United States. It is widely followed as a gauge of the health of the small cap companies. Some of the pros would be it gives exposure to small cap companies, providing exposure to a sector that can offer increased growth and potential compared to large cap companies. Russell 2000 also provides a good representation of the performance of small cap companies, giving traders and investors a good idea of the health of that sector. Some of the cons would be it is generally more volatile and less established than large cap companies, which can increase the risk of associated with investing in the Russell 2000, and it also limited diversification because it only tracks small cap companies and does not provide exposure to other sectors of the market. Companies can also be listed on multiple exchanges since they qualify for them. For example, we have Apple, Microsoft, Amazon. They are all part of the S&P 500 and the NASDAQ, while Johnson & Johnson and Coca-Cola is listed on the Dow Jones and the S&P 500. To summarize, the S&P 500, NASDAQ, and Dow Jones Industrial Average and Russell 2000 are the four major stock market indices in the US, each representing different segments of the market. Investors and traders can choose to invest or trade in these indices through index funds, ETFs, future contracts, or individual stocks. Understanding the pros and cons of each index and the different ways to invest and trade in them is crucial for making informed decisions in the stock market. That's all for today's video. If you like what you learned, please hit the like and subscribe button. Thank you.